So we have the great pleasure today of having as our facilitator, Tori Charves. Tori, she's an enrolled agent with the IRS. She has over 35 years of experience in taxes. She is the owner of Tax Goddess, which is located in the Bay Area. She has done many things. Among those, prior to having her own business, she worked as an accounting manager with a wholesale company for over a decade. She has volunteered with San Francisco State University for their VITA sites for over 12 years. She's a faculty member at Lorman Education Services, and she has served in various capacities on the Mission Society of Enrolled Agent Board and the California Society of Enrolled Agents. So we are very pleased and privileged to have her with us to share her knowledge. And before I turn it over to Tori, we have a disclaimer from the IRS, and I'll just give some of the highlights. So this program for the volunteers is public service. They do not receive any compensation from the IRS. Also, that instructor, the organization that's partnering with the IRS does not receive compensation nor preference, and does not receive any preference when it comes to taxes. Again, the IRS and the US government, they are not endorsing or guaranteeing the use of the instructor services or their business. And by the IRS sponsoring or not sponsoring any organization with which the instructor has a relationship, it does not result in any special treatment from the IRS for that instructor or affiliated organization. So with those disclosures, before I turn it over to Tori, just one more reminder that we do ask that you place yourself on mute unless you are asking the question, so we can make sure that everyone has the ability to learn the great things that Tori will share with us. So without further ado, let me turn it over to Tori.
Thank you, Steve. Okay, good morning. Thank you for joining us. And they're right, I don't get special treatment from the IRS or the state. I think I actually get looked at more carefully, so they can pick on me. No, just kidding. They don't pick on anybody. So we're going to talk about what you need to know about federal taxes and your business. I'm going to reference some publications from the IRS, and I will drop those into the chat box for you to go ahead and download. Another really good site, and I will type that into the chat box, is irs.gov, not irs.com. irs.com is not the federal government. So irs.gov is where you want to go for the actual internal revenue. They've got a great site. It has a lot of information. It's been revamped several times over the past several years, and it's just so much user-friendly, so much more user-friendly. Okay, next slide. So the very first thing as a business owner is you should get an employer identification number, or an EIN, as we call it. We tend to abbreviate a lot in the tax world. So an EIN is a number that identifies your business. It also helps so that you do not have to use your social security number, which is great for identity protections, so that you're not just putting out your social security number to a whole bunch of people for business purposes. So you can get an EIN number whether you pay wages or not. So it's just a protection thing, all right? It is required if you want to pay wages, but you don't have to. Okay, self-employed retirement plans. If you form a partnership or a corporation, and a sole proprietor, if you form any type of business entity, that entity is considered a person in the eyes of the IRS. the Franchise Tax Board, any government agency. A business entity like a corporation, an S Corp, they are people under the Internal Revenue Code, okay? If you have to do any kind of fiduciary, if you're acting as a fiduciary, a trust, estate, you want to open a business bank account. You don't want to be using your personal bank account to be conducting your business. It's referred to as commingling funds, and it gets very difficult to distinguish what was a personal expense, what's a business expense. Well, you know, that trip you took to Home Depot, how do I know that's business? I need to see the receipt, and we're going to talk about record keeping and receipts and accounting for all of those type of business expenses as we move on. Okay. The way you get your EIN number is you go to irs.gov and type in EIN, or on the front page, actually, you'll be able to see apply for an employer identification number, or you fill out the form, you fill out the SS4, okay? So you can do it online. When you do it online, you immediately get your EIN number and download and put and save a copy of that PDF. Because when you go to the bank or you go to something and you want to have that, you want to have that number at your hand. Don't throw that letter away, okay? If you're not sure and you want more information on that, just download Pub 1635 from the IRS website. Okay, next slide. So record keeping. Record keeping is extremely important. I find that sometimes new business owners don't realize that they need to keep their receipts. So you want to have all your income, you want to have your purchases so that we can properly get your deductions and credits. And we'll talk a little bit about what's the difference between a deduction and a credit for tax purposes. Please keep the records for at least 3 years. I personally tell my clients keep them forever. No, just kidding. Keep them for 3 years minimum, but 7 years is a good standard. With so many things moving to electronic PDF scanning, you can scan your documents in and then you can keep them even longer because you don't have boxes. You don't have boxes and boxes and boxes of receipts cluttering up an office or a garage or a storage unit. Plus, you don't have to pay for that extra storage. You know, a terabyte hard drive is not thousands of dollars anymore like it used to be back in the day. Now they're like a couple $100 for a full terabyte of data to store all those electronic documents on. Okay. You buy a piece of property, you're going to want to keep that as long as you have that asset. You say, for example, you buy a computer. Computers might change every 3 to 5 years, but as long as you are using that asset in business, piece of equipment, a stove if you're a kitchen, you buy an apartment building because you want to have a rental property. You keep the document in which you purchased that. Okay. You are going to have employees, maybe. You want to keep your employment records for about 4 years, because an audit period is usually 3 years back from the date of that return. They can go further in cases of potential fraud and things like that. But most audits are conducted, especially payroll and sales tax, are conducted for a 3-year period. So they'll say, hey, we're going to audit this period and then count back 3 years. So if you don't have those documents, it becomes a little harder to prove things. Another reason I am an advocate of scanning receipts after you, like once a year after you get them, is have you ever taken one of those thermal credit card receipts out of a box 2 or 3 years after you've bought it? It's black. You can't read it anymore because the thermal paper just goes really, really dark, especially if it's been kept somewhere hot. Okay, you won't be able to read it and see what was on that. So how are you going to prove what you bought? So Publication 583 gives you more information on record keeping and things of that nature. Okay, so we're gonna put that in the chat box. I'm gonna attempt to put it in the chat box. If not, I'll do it later. All right, next slide. Bookkeeping. So along with your receipts, you need to be keeping track. There is single entry bookkeeping, which means you have a daily or monthly record of your income and expenses. You focus on the profit and loss of the business or the income statement. If you're using a software, which I cannot also suggest or endorse software during seminars because it might not be the right software for you. So I don't endorse online, okay? And it's sufficient for reporting your taxes. Now, on a double entry system, they tend to be a little more accurate because it has built-in checks and balances. For every expense, you have a this. For every income, you have a this. And it tends to self-balance. But no, it doesn't automatically reconcile your bank account. You have to reconcile the bank account, okay? And I would suggest you reconcile the bank account because that's how you can sometimes catch fraud. If someone has gotten a hold of your debit card or your bank account information. Okay, next slide. So there are two types of accounting methods. There is the cash method, and again, that's also in Pub 538. Cash method is I report the income when I receive it. So if I got income on December 31st of 2022, it is income for the year 2022. If I paid an expense on January 1st, 2022, it's an expense for the year of 2022. Okay. So cash in, cash out. Very, very simple cash basis. Then there's accrual. Okay. Now accrual is a little more detailed. I sent you an invoice on December 31st. You paid it January 15th. When do I claim that income? Well, on the accrual basis, you claim that income in 2022, even though you haven't been paid yet. Same way I got a bill. Okay, I got a bill for an expense, software or office supplies. I got the bill, but I didn't pay it until January. I incurred the expense in 2022. So I can take the expense in 2022, even though I paid it 30 days or 15 days later. Okay. If I have inventory, so I'm selling a product, I'm selling widgets or what's nots, and I bought a bunch of widgets and whatnots, and I'm selling those, but I'm keeping a stock in my office, my home office, my brick and mortar location. I must use the accrual method for inventory purposes. Because and then we get into the whole cost of goods sold and accounts payable, accounts receivable. On a cash basis business, they don't have those. You don't have receivables, payables, and don't usually have inventory. Okay, so that's where you would be using accrual. Next slide. Business structures. I've already kind of started off with sole proprietor. That is an individual person doing business as themselves, maybe even just using their name as the business name. Okay. There is a partnership. A partnership consists of more than one person. You cannot have a partnership if you are a single person. All right. So a single person is a sole proprietor. Anybody two or more can form partnerships. Okay. And it's not limited to two. I've worked with a legal firm that had 9 lawyers that were a partnership. So there were 9 partners. Okay. There are limited liability companies. Now, the IRS does not recognize the limited liability company as its own entity. It's usually filed as a single member sole proprietor a partnership, or elects to file as a corporation. Limited liability companies were formed by attorneys, is the best way to explain it. So the IRS did not create a whole separate return for an entity that files as an LLC. Okay, so they will file as some other form. Okay, that other form is S Corp or corporation. So if you're not a single member LLC or a partnership, you may elect to file as a corporation. Now, a corporation, again, in the eyes of the Internal Revenue Code, Franchise Tax Board, Board of Equalization, CDTFA for sales tax, and EDD for employment tax, they are people. They are a person. Okay, so a corporation pays its own taxes, files its own tax returns. The shareholders are not normally affected in a C Corp. Now, an S Corp is what we call a flow-through entity. The profits from the corporation flow out to the shareholders in whatever manner is decided amongst the, usually by the shareholders' percentage of ownership. So, and then they in turn report those profits and losses on their personal tax returns. So they're responsible for the tax. The S Corp only pays its franchise tax to the Franchise Tax Board every year. Then the income taxes are pushed out to the shareholders, owners. Same thing with a partnership and an LLC that files as a single member LLC or a partnership LLC. They all flow out to the individual shareholders or members or partners. So they're responsible for the tax. Okay. Any questions? Okay, next slide. And feel free to chat, to put your question in the chat box. I am monitoring the chat as we go, so I can answer questions as we go. You don't have to save them for the end. Okay. So what else about a sole proprietor? Sole proprietors are not incorporated. It is owned by one person. You can use your social security number, or as I suggested before, I would get an EIN. And the owner assumes all the risk for the personal assets, business assets. They are the ultimate responsibility. Okay. They file a 1040 and attach a Schedule C, sole proprietor, and a Schedule SE for self-employment. Okay. And that is because you are the only employee, technically, of a sole proprietorship. No one's paying wages to you. So the SE tax is your Social Security and Medicare on the profits of your sole proprietorship. Right. There are some joint ventures. Husband and wives can sometimes file as a joint venture sole proprietorship. That gets a little more complicated. And if you're getting into some kind of situation like that, you may want to consult with a tax professional and say, is it better for me to be a partnership, or should I do this joint venture on a Schedule C? Okay, next slide. Partnerships. Oh, they are so easy to organize. You don't necessarily have to go to a lawyer to form a partnership, although you may want to if you're not sure about how responsible your partner may be or irresponsible your partner may be. Members will contribute money, labor, property. Labor, we say sweat equity. Okay, but sweat equity has a value. So it's services in exchange for a value. Okay. They share, all the members share in the profits and losses. Okay. The decision-making is split amongst them. There might be a partner who has just a higher percentage than everyone else. When I have, sometimes when I have two people that are forming a partnership, the question I usually ask is, who's going to be 51%? Who's going to be 49%? No, we're 50-50. Okay, so when you try to make a decision and you're at an impasse and you want it this way and you want it this way, who's going to break the tie? Okay, sometimes having that one person with that extra percentage might make the decision making when you come to problems like that a little easier. Look, I have the 51% and this is how it's going to go. And hopefully it doesn't come down to that, but I have seen it in the past occasionally. One person has to make that final decision. Okay. You file a form 1065, that is a partnership return. The profits and losses that flow out to the individual partners is called a Schedule K1. So it is a K1 parentheses 1065 because it refers to a partnership. Okay. There is a publication that's specifically designed for and talks about partnerships, and that is the 541. So you can download, and all of these are available in PDF or HTML, and you can download them right onto your desktops, which is something I would really suggest because then they're right at your fingertips. I'd also bookmark the several tax sites that I'm going to reference, and I will put all those in the chat box as well, because the IRS is where we start, but there are several other agencies that as a business owner, you may be dealing with depending on the type of business you have. Okay. Next slide. Limited liability company. The owners can have a limited amount of liability. It is designed to kind of protect assets, not at the corporation style, but as the limited liability. Okay. It is like a partnership. It's actually, I like to explain it as a glorified partnership. Okay. That's how I see limited liability companies. The taxes flow out to the individual shareholders. Okay. A sole proprietor is going to be called a disregarded entity in the eyes of the IRS. They will file, a single member LLC will file as a sole proprietor, disregarded entity. All right. And if you decide to be a partnership or corporation with the LLC, you have to file Form 8832. And that's where you tell the Internal Revenue Service, this is how I'm going to file my LLC. I'm going to file it as a corporation or as a partnership. Okay. Next slide. S corporations. So an S corporation, again, is much like the partnership and LLC, that the profits and losses flow out to the shareholders. You have to elect to be an S corp. All corporations start out as C corps, but then they elect if they wish to be an S corp. If they wish to be an S corp, they submit Form 2553, and that is the election to be treated as an S corp. Okay, so the S corp again does not pay taxes on income from daily operations. That income or loss will flow out to the individual shareholders, and the shareholders put that stuff on their tax returns. Next. Which then brings us to the corporation. So the corporation is a legal entity separate from its owner. So it's you, your corporation is in front of you. Yet you are behind the corporate veil or corporate wall. Okay. It has its own responsibilities. It is responsible for filing its own tax. It pays its own tax. The owners are considered stockholders or shareholders. It limits the liability to and protects the shareholders. So if someone sues the corporation, they hit that wall because they're suing that entity. And as long as the corporation has obeyed all the rules and not done suspect things or treated their corporation the wrong way, it's very hard to get through that corporate wall or veil and get to the shareholders. It can be done, but it's not easy. There's a lot of factors that go into if they can or will go through that corporate veil. Okay. You want to transfer the ownership, you sell stock. You don't want to be a member of the corporation anymore, you sell your stock. Okay. You can expand the business, you can raise capital by selling stock. We gave this many shares of stock when we formed our corporation, and they're valued at this. And I own this many, and my other shareholders own this, and we still got 15% left. Hey, let's sell some, let's raise some capital. We want to do some improvements on the business, or we need to do some special things. We need to acquire some equipment. Okay. There's lots of reasons for raising the capital. Okay. Next slide. If you want to take money out of the corporation, you have to take it out as wages. If you don't take it out as wages, the income then can be distributed as a dividend. Okay, so you get a corporate dividend. If you are personally invested in any stocks from a broker, you'll get that 1099 dividend or that broker statement every year that says what your total dividends were. Well, if you have a corporation and you want to pay out income to your shareholders, you might issue a dividend. You might issue a quarterly dividend or an annual dividend. Okay. You apply to be a corporation, usually in the state you reside. Okay. So for the purposes of California, you would form a California corporation with the California Secretary of State. And then you get listed on the Secretary of State website and all your shareholder information. Not a lot of it, but you can see that you're a corporation and who your agents are and stuff like that. Some people form corporations in other states. A common comment I get from people is, well, I'm going to form a Nevada corporation because I don't pay, Nevada doesn't charge taxes. Wrong. You can form a corporation in Nevada, but guess what? If your office and you're conducting your business in the state of California, you still owe California tax. Your nexus, your feet, your presence is in the state of California. So California wants that income. They want those taxes. So you would be treated as a foreign corporation doing business in California. So keep that in mind when you're thinking about forming corporations in other states, though, and you still have to file a tax return in that other state if that state does have taxes. So the other most common one that gets dropped is Delaware. So be careful in forming entities out of your state, depending on where you're doing your business. Okay. It also allows the corporation to form its own debts. So in a C Corp, very rarely does the shareholders have to do a personal guarantee. But in my experience, if you form an S Corp, the shareholders usually are required to file a personal guarantee for any kind of debt or credit because it's a flow out entity. It's the monies are coming in, but the profits and losses are moving out to the shareholders. So a lot of times banks, creditors require personal guarantees, whereas not so much with the C Corp. And it files an 1120. So the S Corp files an 1120S. The C Corp files an 1120. Next. Again, oh. Yeah, we're flipping back. That's it. Okay. So the AnewAmerica's Women's Business Center, San Jose. This is, you can email Steve at sdial@anewamerica.org. I am also, and I see the question in the chat and I'll answer that in a second. I'm going to put my email in because I'm a volunteer. I'm going to put my email in the chat. So if you have questions that are a little more detailed or a little more specific to your situation, I am happy to answer those. I'm also putting my cell phone in there, so you can send me a text if you'd like, because it is tax season, and tax season does get a little bit crazy this time of year. For LLCs, I live in California, but can I incorporate in Florida or Nevada? You can absolutely form your LLC in another state. The issue is that state may require you to file an extra tax return. The state of California requires you to file whichever entity return you're filing. However, you're deciding to be your LLC. If you're a single member, you would be that 1040. But the state of California also requires a Form 568, which is a franchise tax, because Franchise Tax Board is the one who oversees income tax in California. So like I said, there are multiple entities you'll be dealing with. You've got IRS, federal, you've got state Franchise Tax Board, you've got the CDTFA, which is the California Department of Tax and Fee Administration. If you're selling a product, you may be required to charge sales tax. I mean, think about, you go to Home Depot and you buy a hammer, and that hammer is $5. The price tag says $5, but when you walk out the door, did you pay $5? No, you paid $5 and change. That extra part is actually the sales tax. So depending on what county you live in, like if you're in, it might be $5.06, right? Well, when you sell a product, you're collecting the sales tax. And what that means is that sales tax is, you are a third-party trustee for the California Department of Tax and Fee Administration, the CDTFA. You have to then send that money to them. You collect it, you get your $5, but you're collecting the sales tax for another government agency. Same thing happens with the EDD, Employment Development Department. You're collecting payroll taxes. Your wage, you might be paying someone minimum wage. Again, depending on your city, that minimum wage could be different. I work with a client in San Diego, and the minimum wage in San Diego is $16.30. So they pay $16.30, plus they also, when they pay out, they have to pay and collect Social Security tax. They have to Medicare tax, SDI, state disability insurance, state income tax, federal tax. Well, so that check for the $16.30 an hour, when they pay the employee, they're not paying them $16.30. They're paying them $16.30 less all those taxes. And those taxes are trustee taxes. All right. They don't belong to the employer. So the employer is not allowed to use those to pay the rent or pay the cell phone or pay anything, because that money doesn't belong to the employer. That money is collected from the employees to be turned over to those state agencies for Medicare, Social Security, state disability insurance, and their federal and state income taxes. So you didn't pay your payroll taxes. Well, you're a trustee. Again, you're a trustee. And the EDD and IRS work together and present payroll taxes. So if you're going to be getting into payroll, you might want to consider taking one of those free payroll classes as well, because it gets into a lot more detail than we're going to get into. But I want to explain something about trustee taxes. The money doesn't belong to you. You have to pay it to the government. Oh, I forgot to send it in. And you've used that money to pay for taxes, and you've used it for buying supplies, and you didn't pay the right things with it. All right. Well, the problem is now you have violated your trustee responsibilities. And because you've violated your trustee responsibilities, they can pierce your corporate veil. They can come right through the corporation and come right at the shareholders. And I have seen this done. Okay, so that's why you're going to want to be really careful on how you're presenting and entering and doing things and using those business funds and what you're using them for. How do you change a C Corp to an LLC? Yikes. Okay, so you're a C corporation, you'd rather be an LLC. That's a little more complicated. Technically, the best way to do it is to close the corporation and form the LLC. Now, if the corporation has assets, you may need to buy the assets from the corporation and put them in the LLC. This is a little bit more complicated. I would want to know personally, it's not for necessarily getting into this for our purposes of our seminar. I would love to talk to you and find out the motivations from going from a C Corp to an LLC, because there are some ramifications. There could be some built-in gains and losses that you might have to report. It might be a little more complicated than you think, changing from one to the other. Okay. There is also there's just a lot of little things, and you have to change each one of your entity things that you're dealing with. If you've been doing payroll, sales tax, payroll taxes, all those things have to be redone. So, any other questions? Okay. Let's see. Oh, go ahead, Steve.
Oh, no, I was just popping up, and just to say, if there are any questions, also feel free to unmute yourself and ask them.
Yep. Oh, come on. I know you guys aren't all that shy. You're business owners. You have to have that. Talk to me.
I'll have a question for that sometimes comes up. When it comes to determining what type of business entity, a lot of people look at liability and think that, just because they're a certain entity that they're protected. There are several situations where it doesn't matter. So how should someone really proceed in looking at entity and also protecting themselves outside of quote unquote that entity umbrella? So
when I'm talking with somebody about forming their new business and starting their new business, what should I be? It's easier to talk about it before the fact rather than, hey, guess what I did this year? I formed a blah, blah, blah. You did a what? I formed a business. Why? Well, because everybody told me. Who's everybody? Everybody. Don't listen to everybody. Okay. So I look at the person's individual situation and the type of business. So are you a bar? Okay, yes, I'm going to be a bar. Oh, I think you should be a corporation, because if someone slips and falls in your bar, they're going to sue you. Okay. And they're going to try to sue you for a lot of money, because we're a litigious society. We like to sue. People like to sue for any reason. I mean, shoot, you spill coffee on yourself at McDonald's and you can get a couple $1 million. I mean, people sue for the strangest things. All right. You gave me food poisoning. I'm going to sue you. If you're a hair salon, for example, or a service business, you went and you're cutting somebody's hair and you cut a couple inches too much and they're unhappy. They're going to sue you. Hair grows back. Do you really need to be a corporation if you're a hair salon? I think if you're a bar, you want to have that protection. But as a hair salon, I don't think you need to be a corporation or an S Corp, because now you're unless you need to put yourself on payroll. Do you have assets to protect? Do you own a home? Do you own cars? Do you own yachts? Do you own a private island? I mean, you want to know what the asset level of protection is needed. All right. I'm cutting hair in my house. all right, oh, I have a house. Now you might want a little bit more protection, but you're also opening your door to somebody walking in the door and slipping over or tripping over the cat or the dog or the rabbit or whatever animal you may have, the kids' toys. All those things need to be looked at. So it might be, we might want to form a corporation, or maybe what we want to do is just get a really high level liability insurance. We can stay a sole proprietor and avoid paying the extra tax filing fees as a corporation, paying the state of California the $800 a year for the right to be a corporation, an S Corp. We can stay and just spend that $800 and have a $2.5 million liability policy. How much protection do you need? Those are the processes I go through when I'm trying to help someone decide to be a business entity. The type of business, the assets they have, and what could they be sued for? I mean, if you're an electrician, I'm probably going to tell you to be a corporation, because you could burn down somebody's house, and you want that protection if you did a miswiring, and maybe it wasn't even you. Maybe one of your subcontractors miswired something. So hopefully that gives you a little more information on how and when and get some consulting. So someone started an Airbnb and fixed the house up so it complies with the regulations. You pay a handyman. Yes, it's not, well, it could be a startup expense. Startup expenses are a little bit different. If the Airbnb separate from your house, I mean, it's its own house, its own unit. I don't know that you necessarily would have startup expenses, but it is an expense. How I would classify it might be a little different and depend on the situation of where the property is, who's using the property, how many rooms, etc. But yes, you would be able to deduct that $100 as an expense. Okay. In cash basis, if I guess they have a business card. Yes, you can have a business credit card on cash basis. Credit cards are considered like cash. Okay, so the day you incur the expense, whether your cash basis or accrual, that's going to make the difference. But a credit card can be used for business purposes. Okay, I own my own home. This person owns their own home and they're planning to build on an additional unit. I would, so it's not, ADU is not separable from my home. I heard that it's not advisable to form an LLC for assets for self-use, the main house. However, I do want to protect myself against liabilities. What should I do? Well, I would agree with you in saying not to form an LLC or a corporation for that, because once you put property into entities like that, it is really hard to get them out, especially if this is mainly your personal house. I have a lot of people who do Airbnb. I have a lot of people who have multi-unit rentals. They might have a 3-bedroom and they're living in half the house and they're renting out half the house. There are ways to handle that tax-wise. So you can get a rider insurance on your homeowner's insurance. You can take out a separate liability insurance. You can take out a separate protection business insurance for that particular unit. There's a lot of factors that'll go into that. And like I said, anybody who takes the class, I am happy to give you free consultation. That is one of the benefits that I like to give back in helping AnewAmerica and the IRS is I've put my email and phone number in the chat, and I am happy to give you up to a 1-hour free consultation. So happy to book that. We could do it Zoom. We could do it anywhere. I'm in the Bay Area. So, and if most of you are in the Bay Area, I am more than happy to meet and help. Okay. So you can use a credit card on December, but you make the payment to the credit on January. Which year do you take the expense? December. Because remember, a credit card, in the eyes of accounting, we treat credit card as if you had paid cash. So are you on cash or accrual is the next question. If you're cash basis, when you actually incurred the expense, or did you get a bill and then you're paying everything by bill? I usually treat, when I work with a client, I treat credit card expenses as if they were paying cash and look at the cash or accrual basis. Okay. Paychecks, paper checks. Well, again, cash or accrual, because what is the date on that paycheck? If the date on that check is December 15th, 2022, it's a 2022 payroll expense. Okay. If they didn't cash the check until January, that's not your problem. The cash was available to them. They had it in hand. They chose not to cash the check until the next month. It's still your expense in December. Same thing goes with checks you receive as a business owner. If a client pays you on December, but you didn't deposit the money until January, guess what? It's December income, because you had access to it, you had the rights to it, and you had it in hand and available. So even if you put it in the desk drawer and you say, I'm not going to deposit those until the 5th or 6th. Okay, now I can shift that income. Nope. Nope. The government agencies are aware of those tactics. And if you are audited, if ever you are audited, the first thing they are going to ask for is they're going to ask for not only the year's bank statements, but the month before and the month after. So they'll ask for that December, they'll ask for those bank statements bookending that year, because they're going to say, oh, look, that's interesting. You had no deposits in December and you made these huge deposits in January. That's interesting. I think some of those deposits maybe belong to December. So they like those kind of things. Okay. I think that's all the questions so far. Anybody doing gig economy? Oh, and by the way, cash is taxable. Cash is taxable. Cash money is taxable. Don't think you don't have to report your cash. You have to report your cash. Okay. And what do you mean cash? They told me if I didn't use cash, I just didn't have to report it. Yes, you do. Because if someone wrote you a check and you went to the check cashing place and cashed it, there's still a paper trail. We love paper trails. Paper trails are fun, okay, because they lead to all kinds of interesting things. They look at the way you live. I mean, if you're going to be audited, and nobody can protect themselves from audit. Audit's random. You never know if, when, who, how. It just happens. They're not picking on you. I sometimes tease the people I know in the IRS that which dartboard letter got hit this year. Okay, you threw the dart. Oh, they're going to audit all the S's this year. Oh, they're going to audit all the contractors this year. Oh no, I think they're gonna go after the servers this year because the economy is coming back after COVID. So there's no rhyme or reason to an audit. Things happen and they decide, oh, we'd like to look at this. So don't be afraid if you get an audit. They're actually sometimes really good. They're very learning experiences. Oh, I didn't know that happened. Okay. Get in touch with a paid preparer. Work with a paid preparer. Okay. Work with professionals, because sometimes your business is your business. And sometimes the paperwork and the laws and the rules can take up so much of your time that you get lost and you don't focus on your business and you start to lose the grasp on what you're actually doing. Don't let your business run you. You run your business. Okay. Let's see, can I repeat my comment about DE and taxes? DE is in Delaware or Delaware? There's a lot of people that will form corporations in Delaware. And because they think, oh, well, Delaware has better corporate protections for people. That goes back to, do you really need to be a corporation? And where are you conducting business? If your business is in California, you still have to file and report yourself to the Secretary of State in California and register yourself as a foreign corporation. So not only do you have to file forms in Delaware and report things to Delaware, you still have to pay California, be in California and report to California. Okay. How do you find the right person? You can ask for, as far as paid preparers, ask your friends, ask your family, get references. There's tons of places. Go on to the any of the websites, tax prepared. Go on to Yelp. I usually tell people start with referrals. Start with the people you know, or start with like-kind business owners. If you're in a business group, maybe you're in a support network, a business network, a leads club to help promote your business. Usually there's people in there that can steer you in those directions. Okay. You want a preparer who has had some experience in the field that you're working with. As an enrolled agent, I am required to take continuing education every year. And like Steve mentioned, I have over a lot of years. I started when I was 5, and this is my 38th tax season. So I was a child prodigy. I have to have 72 hours of continuing education every 3 years. I have to renew that license every 3 years. Okay. Find somebody who meshes with you too. Not all preparers are created equal, but not all personalities mesh either. So if you don't have a good feeling about it, then you part ways and you go find somebody else. Okay. There are plenty of companies out there. There are lots. It's tax time. You're going to see all the ads on TV for the big green box and the Statue of Liberty company. See, I told you I can't endorse anybody, but I can refer to them. Okay. Yes, you're going to see tons of ads. They do taxes. Okay. Sometimes you just need to ask, do you specialize? Are you familiar with? Have you ever done this type of business? And sometimes you'll get a preparer that says, you know what? I have never done one of those, but I do have a colleague who does. And you may get that referral directly from the person you've been working with in the past. That's another way to get referrals. So, woohoo, look at that. I think we're 4 minutes to go.
Okay, so with that, we will give the last call for one more. So type, if you type, please type very quickly. Unmute yourself and ask your question. So going once, going twice. So that is it. So we like to thank Tori for taking the time to impart her wisdom and knowledge in terms of taxes. There is a question that popped up. This has been recorded, so probably within the next 2 weeks, it will be available on our site at www.AnewAmerica.org under our Women's Business Center in San Jose. So we'll be on the page for the Women's Business Center for San Jose. For those who can't wait, we are fortunate to have a prior webinar on the same topic with Tori that is currently available at that site for review. But this one that we're doing today, which is the same topic, we will make it available roughly in about 2 weeks on our site. And before we go, I really want to thank and at least introduce our partner from the Internal Revenue Service, which is a great partner in terms of really helping small businesses understand, the federal taxes and trying to really impart the knowledge that's needed for them to be successful in running their businesses as it relates to federal tax obligations. So that is Rena Newell. She is the Senior Stakeholder Liaison for the Regional Office of the IRS.
Well, good afternoon, everyone, and thank you all so much for participating. And I also want to thank both AnewAmerica, Steve and Darlene, as well as as I call her, the rock star. You guys had a very good presenter. She's very knowledgeable. But I want you all to know that this is something that we do for the community. We do outreach and education, and IRS's ultimate goal is to ensure that everybody has the proper tools to have a successful business and to know what your requirements are as an employer. Steve has several of these going on, and you can always, as Tori indicated, go to irs.gov and look at upcoming webinars for various things for small businesses. So I really want to thank you all for this opportunity. I hope you all continue and spread the word that IRS is here to help those individuals who have their businesses. Thank you all so much for the partnership as well as the participation.
Thank you. Thank you, Rena. Thank you, Tori, again, and thank you everyone for taking the time to participate. This concludes our webinar for today. Thank you and have a great afternoon.
Thank you.